Hi, everyone. So here we are doing chapter 10, and this one is all about liabilities. And so as you see from the screen, we will be covering current liabilities, payroll liabilities, installment notes, employees, fringe benefits, and contingencies. So if you don't know what the last few were, no worries. We will dive into that and we will figure it out together, okay? All right, so with that, let's go to the next slide. All right, so current liabilities. So we won't spend a whole lot of time on current liabilities because we have already explored, dissected this in previous chapters. But in essence, if you're looking at this picture, a current liability is usually you have a creditor that's involved. So maybe you are the one that's borrowing money from maybe a bank, or you're buying supplies on account or something of that nature, right? Um, so that's current liabilities for the most part. And as I mentioned, we won't spend a whole lot of time on this, but what you should know is that usually when we're talking about liabilities, or what we've seen in the past, is we purchased maybe supplies or inventory on account. So we will get the inventory or the account, we'll get the inventory, excuse me, or the supplies, and then we would do an IOU, also known as an accounts payable. And then usually at the end of the very end of the period, we do an accrual entry. And if you guys can think back to chapter 3, where we were doing accruals, where we're like, hey, everything that I do, all of the expenses that I incurred, was it accounted for? And so one of the most popular journal entries or adjusting entries that we did in chapter 3 was when we had wage expense and then wages payable, okay? So all of those, again, if you're a little stuck or not quite sure what we're talking about when we're talking about accounts payable, then, or adjusting entries, that's what we learned in the very beginning of the chapter. All right, so now what we'll spend most of our time at is talking about short-term notes payable. So if you guys can think back to maybe chapter 8, I want to believe it was the very end of chapter 8. We kind of breezed past it, but chapter 8 was all about notes receivable and interest revenue and things like that. So if you didn't get a chance to look at that, no worries. This is kind of a mirror image of notes receivable, right? But anyways, going back into short-term notes payable, is very similar to notes receivable. When you as a company issue a notes payable, it could be for the purchase of merchandise. Now, a situation in which this would maybe take place is if you're a new business and you're just starting out. Maybe you don't have credit yet, right? And so what maybe a supplier may say is, oh, I'm willing to give you this inventory only if you pay me with interest, right? Or maybe you've burned a client before and you're slowly trying to build that trust again. And so they'll charge you with interest or something of that nature. Another time where we would usually use a short-term note payable is if we're doing some kind of exchange. Now, this exchange can be to satisfy a previous accounts payable. So you're doing somewhat of a swap. And then the last one that's very familiar to most of us is when we borrow money from a bank. That is probably the most obvious example of a notes payable, where you go get a short-term loan from a bank and they give you cash. So regardless of the situation, we're going to dive into all 3 situations, okay? So try to keep in the back of your mind those 3 scenarios. All right. So here's a scenario where I'll let you guys read through this on your own. I really want to spend my time where it makes the most sense, but take a look at this slide. And so remember, if there's a borrower or a debtor, that's also a lender or a creditor on the other end, right? No one's just borrowing money from themselves. There's got to be another party on the other side of this. So this is what the transactions will look like when you're borrowing money from another party or you're lending money to another party. Okay, so today what we're focusing on is we're the borrower. We're the one that's incurring the debt. Okay. All right, so let's go through this example. So assume that Nature Sunshine Company issued a 90-day 12% note for $1,000 dated August 1st to Murray Company for a $1,000 note that's overdue. Now, before we dive into more about this, I need to point out some language. So the book is a little bit confusing as they talk about short-term notes payable, but Nature Sunshine is the one that's borrowing money or issuing debt. And so it's the way it's stated is a little bit backwards from how we're used to it. But again, Nature Sunshine is the one with that's promising principal plus interest. Okay. Now, in this particular scenario, what's going on is they previously had an accounts payable, right? And maybe they didn't pay within the 30 days or the terms before. And now what's happening is they're swapping the accounts payable, the original accounts payable for notes payable. So what in essence is happening is they're, in layman's term, or as I like to say it is, they're saying, oh, my bad, I'm sorry I didn't pay you within the 30 days. If you give me another 90 days, I promise to pay you what I owe you plus interest. That's what's happening, okay? And so all of this is a result of maybe the seller or what have you agreeing to those terms. Now, on October 30th, this is the Nature Sunshine coming back to fulfill on their promise. So what you see is them paying the notes payable off, the liability. They're paying that notes payable off plus the interest that they promised, right? And then the credit is cash. Cash is going out the door. Okay, so hopefully that made a little bit sense. If not, no worries. We're going to go through plenty of examples of all three. Okay, so now let's take it from the example of what we're most, I guess, used to. All right, so assume that on September 19, Iceberg Company borrowed cash from First National Bank by issuing a 4,000 90-day 15% note to the bank. So imagine when you go and get a loan from the bank, when you originally get a loan from the bank, they give you the money right away. There's no interest initially involved in that transaction, right? So if you go get a loan for $5,000, or in our case, as we read through this example, when you go get that loan for $4,000, that's the amount you're going to get. Now, when this loan is due, that's when you pay back principal plus interest. Okay, so before we dive into any examples, let's talk about when a loan is due. Okay, so yeah, perfect time to do a breakout session. But before that, what I want to do is page through all three examples, all through scenarios, and then how to calculate interest. Okay, so when something is at maturity, hopefully from chapter 8 or maybe now, when something is at maturity, what that means is the note that was promised, the note plus interest is due. That's what maturity is. So maybe, for instance, you take out a loan on May 1st, right? And you're saying in 30 days, I promise to pay, right? So on May 31st, right, that is considered maturity of that particular loan. So what's due when you pay that loan is, again, it's going to be the original amount of the loan plus the interest that that's on that loan. Okay, now for a second, let's talk about how to calculate interest. Okay, now the way we calculate interest is going to be this formula here. It's going to be the principal amount times the interest rate times the term over 360. Okay, so let's take, for example, maybe what we're doing here is this scenario. So I don't want to switch screens. So for a second, let's take, for instance, we're doing a 90-day 12% note, and it's the principal amount is 1,000. So to find the interest, the way we plug in interest again, or how we are calculating interest on this particular loan, is we're going to do the principal of $1,000 times the interest rate, which is 12%, times the term. Our term is 90 days, right? So times 90 days over 360. Okay, so don't forget to solve this part first, and then you go here, and then you go here. And so when you do so, the amount that you will yield is $30. Okay. Now, what I need to make sure you understand is that's just the interest. But remember, at maturity, you must pay the original loan amount plus interest. Right? So for us, the original loan amount was $1,000 plus the interest that we calculated was 30. So at maturity, you owe $1,030. Okay. So hopefully that made sense. If not, please let me know, or please go back through the video and then pause it, stop it, or send me an email, and then we can talk about it.